Welcome to the course Microfinance. This is lecture 1, an introduction to microfinance. And more generally, it covers macro, money, and international finance. Welcome again. Let's get started right away. What we will do in this lecture is to ask ourselves, what is really microfinance? We contrast different financial frictions, and then we contrast the portfolio investment risk-focused macroeconomy with the consumption-focused macroeconomy. Most of macroeconomics focuses on the latter one, which focuses very much on individual and aggregate consumption, while we are focusing here more on the finance component. We will first discuss today amplifications, resistance, and resilience to shocks in the first generation macro models, where typically there's an unanticipated shock, a zero probability shock, or also sometimes called an MIT shock, which reverses back to the steady state. So the system then reverses back to the steady state deterministically. Later, we will generalize the setting and allow more shocks, continuously shocks arising, where the system is not reverting back to the steady state deterministically. So first, let's get an idea how the GDP moves in the United States and also many other countries. So here what I've plotted is the GDP in a log scale. So there's a log scale on the y-axis over time. And what you can see is really perplexing is that roughly the GDP is growing at a constant growth rate. So on log, it's a linear trend line is going down. Of course, we have wiggles, we have recessions, we have booms, but on average, it always comes back to the old trend growth line. There are two exceptions. The first exception is the Great Depression in the 1930s, where you see a decline, significant decline, and a long-lasting decline. And it only returns back after the Second World War, where there was significant intervention on the fiscal side because of the war efforts, and we came back to the old trend line. The second exception is essentially after the global financial crisis in 2008, where not only did we not come back to the old trend line, actually the new trend line actually has a much lower slope compared to the old trend line. So the growth rate is actually not now much lower. Let's zoom in at the more recent events after the global financial crisis. And you can see first, dot-com bubble in the late 1990s, leading to excessive beyond trendline growth. Then there's the burst, and then you see the global financial crisis, and then a gap opened up. Not only there's a gap opening up compared to the previous trend line, which lasted for more than 100 years, it is actually also the growth rate is lower. So the gap is widening over time. Interestingly, the COVID crisis, which started in 2020 in the United States, led to a huge sharp decline, but we recovered from the sharp decline. So the gap which we are facing per year is about 3 to 4 trillion every year. And the gap is actually growing further and further. And if you look at the whole shaded area, that's the whole lost GDP over the years. And so what I want to draw from this is that, if you look at financial crisis, the Great Depression and also the 2008 global financial crisis, it leads to significant loss in GDP and also GDP growth rate. And both of these phenomena actually lead to huge welfare losses over time, which are very, very significant in the trillions of the dollars. And this is just for the United States. Of course, at the global level, it's even bigger if you sum everything up. So that is one motivation. There's a lack of resilience. Resilience means after a shock, you bounce back, you recover to the old trend line. After financial crisis, there's typically a lack of resilience. So that's why we would like to understand why it is the case that we don't bounce back to the old trend line after financial crisis, and gives us a great motivation for why macrofinance is actually of first order importance, quantitatively and also qualitatively to try to understand what's going on. So if I go back in history, in the history of economic thought, you can think of the big giants in our fields like Ivan Fisher, Keynes, and so forth. They all had macro and finance in mind. So none of them really ignored the finance component, the macroeconomy, and the finance was not, in the finance field was, not a separate field. It was all macroeconomics and finance together. And one way to classify how the history of thought evolved is that in macro, after the Second World War, was very much focused on the growth theory. Think of Solow's growth model and earlier models and subsequent models. It was all dynamic, and many of these models were in continuous time. But they were very much focused in deterministic settings. There was no stochastic element to it. While the finance moved in the other direction, there was a split in the profession to some extent. Finance had more portfolio theory, so it was not dynamic, it was a static setting, but it emphasized very much the stochastic elements. So here I've depicted here just the CAPM efficient frontier portfolio, and here the risk-free rate. So you see the tendency portfolio, just the CAPM picture. Now, in the 1970s, what happened is that in macroeconomics, people moved beyond a deterministic dynamic setting. They introduced uncertainty, they introduced stochastic elements. But they did this primarily in a discrete time setting. So the real business cycle theory with Brock, Meerman, Stokely, Lucas' famous book, all of them, they started to introduce discrete time stochastic elements. So not going away from continuous time models. In the 1980s, then dynamic stochastic general equilibrium models became very prominent, also with price stickiness, so the so-called DSG models, where it's stochastic, the S stands for stochastic, and G is for general equilibrium, was integrated as well. All of them, most of them were in discrete time. In finance, however, one moved from the stochastic element, maintaining it, but also introduced some dynamics. And this dynamics was done in continuous times. And classic examples are the option pricing formula, a la Black and Scholes, term structure models like Cox-Ingersoll-Ross, a prominent example of term structure models, interest rate term structure models. And then also more recently, agency theory, where agency frictions were modeled, where Yuli Sannikov made some important early contributions. And I would argue that, after the global financial crisis, the literature between macro and finance is coming back together in combining it in a continuous time macro with financial frictions, where the financial frictions play a prominent role, are not just a veil and can be assumed away. And we will discuss these financial frictions very, very prominently in this lecture, and also the implications on the macroeconomy. That's essentially what macrofinance is all about. So what is really macrofinance? So it's about macro, it's about aggregate impacts, it's about the resource allocation and the constraints the macroeconomy faces. And it's about finance, it's about the risk allocation. Who holds what amount of risk? And is this allocation of risk, not only of goods and services, is the allocation of risk also optimal? And in a world with financial frictions, you might have contracting frictions, but of course you have different agents, heterogeneous agents which differ, and institutions matter and liquidity issues matter as well in these frameworks. So that's what macrofinance is. Later in the course, we will also introduce monetary elements where inside money is created by these financial institutions. So financial institutions, they issue demand deposits, which are inside money, and their financial institutions create money to overcome monetary frictions on top of it. The big questions in macrofinance is how to design the financial sector, how to design the government bond market, how is it valued, what role does the government bond market take, and so forth, in order to achieve an optimal resource and an optimal risk allocation. A resource, I mean goods and services, are optimally allocated across the population, but also the risk and the capital is optimally allocated. So the topics include what we study today: amplifications, percolation of shocks in the cross-section across different players, resilience, how quickly will the whole system bounce back, and financial cycles in a longer run cycle than business cycles. Financial stability issues and spillovers and systemic risk measures are, of course, at the core of macrofinance as well. And on top of it, it's central bank policy, conventional and unconventional central bank policy. What should be the optimal balance sheet of a central bank? What's the optimal maturity structure? Should the central bank issue CBDC, central bank digital currencies? These are all topics part of the macrofinance literature. And of course, capital flows across sectors, but in the international setting across different countries is also at the core of macrofinance. So macrofinance essentially covers all the interesting things you want to think about in order to find a better resource and risk allocation for the macroeconomy. And by doing so, you increase welfare and not only GDP and level and growth rates, but also overall welfare for the citizens in the economy. Now, here's a big picture of what macrofinance is about. So it captures elements of macro, which is more consumption, emphasizing consumption mostly, and also finance, which emphasizes very much investment and risk premium. And here's there's an overlap between the two. That's where the macrofinance literature comes in. But all of this captures macrofinance. So if you think about famous papers in intermediation, Diamond Dipping, Ediant, Allen and Gale, Homstem Tirol, corporate finance, household finance, behavioral finance, asset pricing, a la Bob Merton, option pricing, and Black and Scholes, as I mentioned before, or former French type asset pricing. They're more squarely in finance, but there are many models which are overlapping with macro, in particular in the Lucas models. Kiyotaki-Moore we will discuss today. Bernanke-Görtler-Gilchrist we will discuss today as well. And we will focus very much on work by myself as Yuli Sannikov and Heen Krishnamurti, and on top of it, studying safe assets, intermediation theory of money in an incomplete market settings. And, that touches on other papers, which the heterogeneous agents, New Keynesian models. We will also have heterogeneous agents. We might not have necessarily price stickiness like in the New Keynesian models, but this can be incorporated as well. And of course, the macro of Ayagari models Mike Woodford with price stickiness in the monetary setting, Kiyotaki-Wright monetary models, Lagos-Wright models, and there are many, many more which are not incorporated that. But the intersection of all of them is actually where macrofinance plays a critical role. And I should also say there's, of course, by designing the public debt, the public finance, and the taxation, public finance elements are also a big component in macrofinance. So here I see a big picture overview. There's no clear-cut definition of macrofinance. I would say whenever risk considerations play an important role and risk premia, time-varying risk premia play an important role, getting stuck, having not the resilience after a shock, not recovering well from these shocks, in particular financial crisis, then macrofinance is at the core of the element. As I said, importantly, you need, if there's financing going on, you need heterogeneous agents because there's some lending borrowing relationship or some insurance relationship, and typically you have different types of agents. So for example, some people are poor today and rich tomorrow or in the future, while others are rich today but poor in the future. So they can ideally they can borrow, these people borrow from those people. There's a lending relationship. If everybody is the same, you don't need to borrow and lend at all. But you might also borrow if you're more productive than others. The less productive might lend to the more productive ones, or they might also share some risk. They might also be the less patient. They might be, willing to borrow from the more patient ones. And if they have different risk aversion, they might, the less risk averse, they might insure the more risk averse. Or it's also more optimistic ones might ensure the more pessimistic ones. So in all of these settings, there's heterogeneity. There can be heterogeneity in endowments and also in productivity, but also heterogeneity in preferences. So there's a huge set of possibilities of heterogeneity, which is necessary to have these heterogeneous agents in order to talk meaningful about financial frictions. If everybody is the same, there's no financing needed. So financial frictions don't really play any role. But with financial frictions, the state prices across agents or the stochastic discount factors or the margin rate of substitution probability weighted, they're differ potentially because there are frictions that cannot equate even after transactions, even after financial claims are traded. And that's because of these frictions. And when we have these frictions, then the wealth distribution matters. Who is wealthy, who is less wealthy, who has higher net worth matters big time in these frameworks. We will see that if the productive have a lot of net worth, they can produce a lot, but if the wealth is stuck in the less productive hands and frictions prevent them to lend to the more productive one, then actually depresses the aggregate economy. So whether certain sectors in the economy are balance sheet impaired, so that is they don't have enough net worth, that affects the aggregate outcome and affects not only risk sharing, but also productivity. And the financial sector is also not the veil. So in a world with perfect perfect markets and no financial frictions, the wealth distribution doesn't matter. And also financial sector doesn't matter. The role of the financial sector in these microfinance models is typically to minimize the implications of financial frictions. And there are big financial frictions, and when the financial sector should reduce the implications of the financial frictions to minimize it. In particular, think of financial frictions when the financial sector monitors in order to reduce asymmetric information problems and other financial frictions. So this leads us immediately to the question, what are the various forms of financial frictions? Now, so here is the financial frictions we will discuss in this lecture. So first, you can have incubate markets frictions. You can have leverage constraints as a particular friction. You might have some surge frictions, or you might also have some belief distortions, that the latter is more heterogeneity, but they're distortions from the rational expectations beliefs. So let's go in more detail about incubate market frictions. Incubate market frictions, complete markets, mean that you can trade essentially contingent on each state of the world. So there's a complete market of that. So in the simple example I've depicted in this figure here, the only two states of the world, state 1 and state 2. So you can actually trade, can move a payoff along the state 1 axis or the state 2 axis, but it does need to be the Börse securities. You can be anything. So you have two vectors which are not aligned to each other. So two vectors span essentially the whole payoff space here. So whenever you have complete markets in this setting, you only have two states. You need essentially two payoff vectors for two particular assets. So each asset has a payoff, and my payoff something in state 1 and state 2. So it's a vector with two entries in this world. And you need two different ones such that you can actually span this whole plane. So then you have a complete span, a complete asset span, and markets are complete if these two assets can be traded without any frictions. Now you can argue you can probably not trade. So let's suppose there's only one asset, which is, let's say, a payoff of 1-1. So this is a vector of 1-1, this along this red line. You can buy, of course, two of the assets. You can move further up. By three of the assets, you can move further and further up, and that's what you get in the next period in these two states of the world. You can also borrow. So if you borrow, you have to pay back. So you have to pay -1 next period. Or if you borrow 2 units, -2, -2, and so forth. So you can go short the bond or you can go long the bond. So in an economy where you can only trade along this line, that these are incubate markets. Now, often what we assume that you cannot trade all state contingent claims, and you can only trade in a subspace. So the state space might be hundreds of states of the world, or even infinitely many, and you can only trade a subspace. And here I've just depicted two states of the world. You can only trade, let's say, a risk-free bond, which is along this line, which is a subspace of this two-dimensional plane. Now, what we will do is we'll study these incubate markets. Like in my work with Yuli, you can only trade, for example, this bond. And there will be a natural leverage constraint. How much you will borrow depends on your risk aversion, because you don't want to borrow too much and take on too much risk, and that limits how much you want to borrow. In Bernanke-Gottler-Gilches, you have this cost estate verification aspects to it, which it goes back to Townsend's analysis in the 1970s, where you want to issue only debt claims. So that's because there's only the debt financing is going on. And because of these debt claims, you essentially also have endogenously some incubate markets. Now, in many of these models, you cannot issue any contingent claims at all. You can just issue debt along this red line. And you might on top of it have some leverage constraints. So one option is to say, okay, I can issue bonds. By issuing bonds, meaning you're on this part of the red line, you can issue at this up to some exogenous limit. You can issue 2 bonds. That's what's assumed typically in Bewley models or in Iagari models. Purcell-Smith assumes you cannot issue at all something. But the way, what the leverage constraint is, how constrained the leverage ratio is, can also depend, can be not necessarily be exogenous, but can also depend on the price. So for example, it can depend on the collateral constraints. So if you have collateral constraints and not simple debt constraints, which are exogenous limits, but you have collateral constraints, so it depends how much you can issue, depends on the value of your capital, for example. So if K is a number of machines or physical capital you have, and Q is the price of it, so it's the value of your collateral today, and this could be how much you can borrow. So then how much you can borrow depends on the price of the machines. But more naturally, it should not be today's price, but next period's price when you pay back the debt. So it's QT plus 1. That's assumed in Kiyotaki-Mura. That's sensible in Kiyotaki-Mura because in Kiyotaki-Mura, next period's price is perfectly known. But in reality, we don't know what next period's price is. And then you might assume actually some value at risk of next period's price. The value at risk is the worst 1% quantile, let's say, what's happening for next period's price. So rather than assuming some expected value of next period's price, you assume the worst potential price realizing. That's in my work with Lasse Peterson. We assume the debt level is actually then driven by the next period's price times the number of the machines of physical capital you have. So these are different forms of collateral constraints, but importantly, the big classification is you have incubate markets. You might not be able to issue some contingent claims like equity claims, which really say, oh, I issued some claims whose payoff, it depends very much what the performance of the underlying firm is. You can only, for example, issue debt claims. And then the question is how much of the debt claims you can issue. It could be an exogenous limit, or it could be a collateral constraint. And we will analyze many of these different forms of constraints of these financing frictions. Now, what the financial sector essentially, as I indicated already earlier, is there in order to overcome these financial frictions and to channel resources in the right direction. So we have these financial frictions that prevents us from going to the first best, from going what the welfare theorems tell us in a classical sense when there are no financial frictions. But the financial sector can help us to mitigate these financial frictions. And it might even create money if there are monetary frictions on top of it. But this creates its own amplification mechanisms because the financial sector might work well in certain times when the financial sector is well capitalized. But when the financial sector is not well capitalized, it cannot mitigate these financial frictions so well. And then the financial frictions come again to the forefront of the whole setting. So that's what's going on in the financial frictions setting. Now, this leads to a when the financial sector gets into difficulties and withdraws, and then the financial frictions come to the forefront again, there can be adverse feedback loops and liquidity spirals, making the situation much worse than it was before. And most of this dynamics is highly nonlinear. And that's will be the focus of this class. We're focusing very much of this whole course on nonlinear dynamics. Sometimes linear dynamics is fine. So traditional macroeconomics typically derives the steady state outcome and log linearizes around the steady state. and approximates deviations from the steady state and how quickly you deviate and recover back, go back to the steady state in a linear system. But most of the systems involving financial frictions are highly nonlinear. Not what we do today, but the many of these problems we'll discuss in the future. And having this financial sector playing an important role, we get in financial frictions more generally, we get new insights to monetary and international economics as well. So microfinance touches on many of the monetary aspects and also international economics aspects. Now, what is, microfinance? How is it different from most of traditional finance? And I mentioned it already that microfinance focuses more on the financing side and less on the consumption side. By financing side, I mean portfolio and investment decisions. And what's really key is a risk premia. It's not only the risk-free rate, but also risk premia. So it's a model with risk, and this risk leads to different risk premia, and it can be term risk, where by the yield curve, you look at short-term interest rate versus the long-term interest rate, and the long-term interest rate also has some risk premium, some term risk premium component. Many of the assets might be risky assets, and for example, might be subject to default risk. And it's not just the expected payoff you get after given potential default, it's also the credit risk premium. So you get the risk premium on this thing. So what are the risk premium? The important element is a risk premium. That's the price of risk times the amount of risk. And the risk itself can be exogenous risk and endogenous risk. And this endogenous risk is a key element to model in microfinance models. So risk premia are time varying. They're time varying because the price of risk might be time varying, but also because endogenous risk might be time varying. So there's risk, exogenous risk, which hits the system from outside. That's what triggers the initial shock. But things might be amplified through spirals and adverse feedback loops. So there's an amplification, leads to higher risk, but it can also through multiple equilibria. So there can be runs or sudden stops, which leads to risk. So the possibility of runs and sudden stops or jumping to a different new static equilibrium is some endogenous risk component. That's risk itself. So both exogenous risk and endogenous risk multiplied by the price of risk gives you the risk premium. You can see that exogenous risk might not be time varying because it comes from outside. Even that might be time varying, but endogenous risk is highly time varying, and the price of risk might be time varying. So risk premium move around. So if you look at the change of asset prices, it is a function not only how future cash flows, news about future cash flows, but also news about how risk premium move around. Okay, so the risk premium moves around a lot. And empirically, we know from asset pricing literature, most of the change in asset prices are change in risk premium rather than the cash flow news. So there might be often no cash flow news at all. Nevertheless, we have huge price swings because risk premium move around. We would like to understand that. And, these huge price swings often occur because the nonlinearities, they're very prominent in macro models. So how the system behaves around the steady state might be very stabilizing, might be not dramatic, but away from the steady state might be very different, might be much more dramatic and much more significant. Okay. So what matters is the heterogeneity of the agents in these microfinance models, but it's more the heterogeneity, the wealth distribution, or the wealth distribution across investors. Of course, the consumers matter too, but the emphasis on the heterogeneity across investors in terms of wealth across different types of investors. So how is this different from consumption decisions or consumer-focused macro, which is most of macroeconomics? There, it's mostly, how do people's consumption change? How can I stimulate consumption? How can I manage the aggregate demand, consumption demand? How can I make, if there's an output gap and there's too little demand, how can I stimulate this demand? And, I change the interest rate, which drives the consumption. So it's a consumption savings decision, which is a key decision. It's not a portfolio and investment decision, a portfolio choice and investment decisions. Now, of course, in many of these models, more recently after the global financial crisis, studied the zero lower bound phenomenon, where you're stuck, you cannot lower the interest rate, and you're stuck in a liquidity trap. Zero lower bound, or it might also be some reversal interest rate, where you lower the interest rate even further and becomes counterproductive, and that's an effective lower bound. Sometimes I've referred to as reversal rate. Now, instead of focusing on time-varying risk premia, because the price of risk moves around or endogenous risk moves around, many of these models assume an expectations hypothesis. When you want to price long-term bonds, you just say, what is the interest rate on the short-term bond today? What will it be in the next period in expectations and next period? And then just putting this together, you get the term structure of interest. So it's driven by the expectations of future short-term interest rates. And term risk premium don't play a prominent role. The uncovered interest rate parity, if in international contexts, is also similarly taking expectations. So whether you borrow in dollars or in a foreign currency, you assume typically uncovered interest rate parity. There's no risk premium associated in most of these models, which is time varying. So there is a limited role for time and risk premium. Now, the heterogeneity in these models, in the Hank type models and other models, is of course important too, but it's a wealth distribution across consumers. So on what you want to do, you have different consumers. Let's say you have some consumers with a high marginal propensity to consume and other consumers who have a low marginal propensity to consume. And then it's the case that if you want to stimulate the aggregate demand, aggregate consumption demand, you take wealth away from the low marginal propensity consumers and shift it to high marginal propensity consumers in order to stimulate and create more aggregate demand in the setting. So this leads already us to the continuous time macro models, which recently in the last 10 years become very much more prominent. And there are two types of models. There are the investor-focused ones, the macrofinance ones, and there are the consumption-focused ones, so-called Hank models. And let me just contrast the two. I mentioned already in the macrofinance models, the net worth distribution matters, heterogeneous agents, but heterogeneous investors focused, while the Hank type of models, it's more heterogeneous consumer focused. And often what in these macrofinance models, you have only a few different types of investors, one or two. In this model today, we will have only two different investors, two types. While in the Hank models, you can have a whole continuous distribution of it. But of course, they are more challenging than to solve. You can also have a whole distribution in the macrofinance models. Now, the tradition, because this one is very much focused on portfolio choice, tradition comes from the finance literature, mostly by the Merton portfolio choice problem. So it's a portfolio choice problem, but also a consumption choice, but emphasis on the portfolio choice here. While in DSG models, which the representative agent setting goes back to important work by Mike Woodford, it is very much the consumption choice, and interest rate is moving then consumption around. And so if we go in the DSG models, what you typically have in most of these models, you have a zero probability shock, which was totally unanticipated. It shocks the system. And then there's transition dynamics back to the steady state. And this transition dynamics is deterministic. And that's what we will do today as well within the macrofinance model. These are traditional first generation models where an unanticipated shock shocks the system. And then it goes back to the old steady state in a deterministic fashion. Hence, the length of the recession is also deterministic. In most of the macrofinance models we will study in this course, with the exception of the models we do today, or the model we do today, we solve the whole system globally. Okay? Because once you have time-varying risk premia, you have to solve it globally. So, and in particular, as I mentioned before, we focus on the nonlinearities away from the steady state, because once you go in a crisis region, the system behaves very differently compared to the region around the steady state, where it's the macroeconomy might be stabilizing, self-stabilizing around the steady state. But if the shock is big enough, or there's sufficiently many shocks, negative shocks, then the system behaves very, very differently. It might not be self-stabilizing. It might be destabilizing itself. And then we want to understand these aspects. And furthermore, because there's not one unanticipated shock, there might be a sequence of shocks coming in the form of Brownian motions. The length of the recession is also stochastic. So in terms of risk, the risk is a predominant there, and idiosyncratic risk and aggregate risk is important. It also carries a price of risk. And financial frictions play an important role, which means, the price of risk, the shadow price of risk might be different from person to person, from agent to agent in this heterogeneous investor setting. In the traditional Hank models, there's no aggregate risk. So in the original Hank model, there's no aggregate risk. So it focuses very much on idiosyncratic risk only, while in this microfinance models, idiosyncratic and aggregate risk are important. The price of risk is not applicable in these consumer-focused models because the risk is only unanticipated coming up front. Now, the assets, you have capital, typically physical capital, machines, you have money, you have bonds, and you can also have some equity claims and other things. All of these assets have different risk profile, and you have to have a rich portfolio choice. You have a risk-return trade-off between them. You might also have a liquidity return trade-off where certain assets cannot be as freely traded as other assets. And in times of crisis, there might be flight to safety. So people might fly out of this more risky capital into money and bonds to fly into safety, and that amplifies situations even further, creating more endogenous risk, which then is also reflected in the price of risk. Now, in the original Hank model and Hank models, all assets are typically risk-free. Hence, there's no risk-return trade-off, but there is liquidity return trade-off because certain assets, like real estate, they cannot be traded so freely than other assets. So that's the emphasis on these Hank models. Now, in order to study money, one has to introduce some, additional elements and also monetary frictions. What in these microfinance models, the risk plays an important role as well, and also in connection with the flight to safety. Of course, capital might be more risky, money might be less risky, and the banks might be issuing some inside money. So financial frictions play an important role. In the New Keynesian Hank, so heterogeneous agents, New Keynesian models, the price stickiness plays the key role to understand money and its implications and output gap. Of course, you can also include price stickiness in the microfinance models, which recent microfinance models do as well. You can also have a more richer risk setting in the Hank type models as well. So at some point, these two literatures probably will converge. Both use continuous time macro models, but the big distinction, I would say, is the emphasis on the investor's heterogeneity versus consumer's heterogeneity, and how the price of risk moves around. Now, with this, let's move on to the next thing. So we have covered the definition, how to define microfinance. We covered the type of frictions, income market frictions, and then borrowing constraint or collateral constraints, how much debt you can issue. And then we talked about portfolio investment risk-focused macro versus consumption-focused macro. Now, what I want to do next is to study the amplification, persistence, and resilience of a first-generation macro finance model with an aggregate MIT shock, so unanticipated MIT shock, where subsequently the economy recovers deterministically and goes back to the steady state. Okay, that's what we want to do in this first generations. There are two Kiyotaki-Moore, and Kiyotaki-Moore is set up in discrete time. So we modify the Kiyotaki-Moore setting to a continuous time model. So it's different from the original Kiyotaki-Moore model, but it is, covers the continuous time equivalent to it and will be closer to the models we will cover later on. And that's why we set up this continuous time Kiyotaki-Moore framework. I will then allude to a related model by Bernanke-Görtler-Gilchrist, which is also a discrete time model, but has a different financial friction in it. In Kiyotaki-Moore, there's a collateral constraint, so you can not issue any equity, some contingent claims, how the firm will do, contingent how it will do, but you can issue only debt. And how much debt you can issue depends on what the value of the collateral will be in the next period. And Bernanke-Görtler-Gilchrist, you can actually issue debt. So you want to endogenously issue debt, and it's a costly state verification framework where you can issue some defaultable debt, but if your default probability is higher, the interest rate you have to pay is also higher. And this leads to higher financing costs. If the firms are suddenly less well capitalized, the default probability is higher, the financing costs will be higher, and that causes a wedge on its own. That's the emphasis of this BGG model. But we will focus on this lecture, and in the Kiyotaki-Moore, modified it to a continuous time framework, and then I will just allude at the end how the Bernanke-Gottler-Gilchrist framework is different. Both focus very much on the amplification of the initial shock, a dynamic amplification. There's a shock. The shock will last longer than initially the shock lasts, but the system is more stuck. There's less resilience, and but it's also initial shock is also amplified. So if I think about persistence and resilience, persistence, even a standard real business cycle model without any financial frictions, a temporary adverse shock can have long-lasting effects. And that's because of some feedback effects, but much longer than initial shock. If you have financial frictions, then actually this persistence might be much stronger because of these financial frictions. And some early papers is an early paper in the American Economic Review by Bernanke-Gottler in 1989, which studies an OLG model, an overlapping generation model, incorporating this. This was a predecessor of the BGG Bernanke-Gottler-Gilchrist from 1997 or 9, later on. Another work is by Karlstrom and Fürst. They have also a similar framework where the financial frictions lead actually to more persistence. Okay? And the reason is that a negative shock, which might last hit here, that destroys some net worth, and that the destruction of net worth, the wealth of these productive guys, destroys this net worth, and that exacerbates the frictions going forward, and it leads also to lower capital holding of in the future, and leads to lower investment, and the net worth is depressed in the future as well. So even though it's only a one period lower shock, it destroys the net worth of these productive agents, and this actually will then drag on going forward as well. Now, there's a static amplification because of this, because the fire sales, the capital will be sold from the productive sector to the less productive sector, for example. And this reduction then, this fire sales reduce the price of the physical capital. That hurts the net worth of the leverage players even further. And that highlights the importance of market liquidity. At what price in the times of crisis can capital be sold or bought, as it has to be sold at fire sale prices, at depressed prices relative to other prices. Now, what Kiyotaki-Moore focuses very much is on dynamic amplification, because the temporary shock translates into persistent decline in output and asset prices. So because there was a temporary shock, net worth is lowered, it leads to persistent output like this gray areas they point out. And asset prices will also be depressed because output will be lower. That means dividend payments or cash flows for these firms are lower. Asset prices are reflecting future cash flows or dividends of these firms. So the asset price will be depressed, or the value of the machines will be depressed. So the collateral value is depressed, and that tightens the collateral constraint. So in a setting like in Kiyotaki-Moore with collateral constraint as an additional friction, the fact that future output is depressed and future profits and revenue of these firms is depressed means the value of these machines is depressed too. That lowers the value of the price, the output of this, what the machines can produce, and that translates in lower value of the thing. And if the lower value of the machines lowers than the value of the collateral, because the collateral is worth less, it is also depressed. So typically in these models, we look at assets which are physical assets, like machines, trees, or whatever produces something explicitly. You can also think of financial assets. Financial asset just claims on these machines, so it's just one step further remote, but you can also think of financial assets being the underlying collateral for satisfying the collateral constraint. So again, there's a temporary shock because this temporary shock destroys net worth for, let's say, the leveraged entities, the leveraged players, heterogeneous agents or group of agents in the economy. They can produce less in the future this way. But because then the cash flow is depressed in the future, asset prices actually take this into account. Then asset prices will actually, from the future, feed back. So there's a forward equation, there's a backwards equation, asset prices feed back, and that tightens the collateral constraint even further. Not also in the future, it tightens the collateral constraint and also tightens further. And there's a dynamic amplification going on. So there's a static amplification going on immediately, but also from the future implications, there's a dynamic amplification going on. So let me go to the continuous time version. So it's a novel continuous time version of Kiyotaki-Moore to illustrate this more formally, how things can be done. So now let's have a look at the Kiyotaki-Moore 1997 model. But let's not look at the original model in discrete time, but modify it to a continuous time version, which then makes it easier to connect to later second generation models. So Kiyotaki-Moore is a first generation model in macrofinance. So there are two types of agents, experts and households. Experts are more productive than households. Kiyotaki-Moore calls them farmers and gatherers. But we will stick with the notation throughout the course with expert and households. So here the experts, they can manage some capital. So the total capital stock in the whole economy is capital K. Q is the price of each individual machine of the capital stock. And kappa E would be fraction of the capital, which is held by the experts. But kappa H is a fraction of the capital stock, which is held by the households. So the total value of all the machines is given by this, and a fraction kappa E is with the experts, and a fraction kappa H is with the household. So the sum of the two is equal to 100%. Okay, and you cannot go short machines. You can go short financial claims. You can issue bonds, and you can issue and go short various financial claims, but you cannot go short a machine in a sense. Now, the experts, they're more productive, so they actually should hold more of the physical capital. How do they finance themselves? Of course, they have some net worth on their own. That's their own wealth, the net worth, that's NE. And they also issue some debt. And the debt is then issued to the households, and the households essentially hold this debt. So their bonds, they are negative in the bond holdings, the experts, and the households are positive in the bond holdings. In total, the aggregates up to zero, because the economy is a total macro economy with general equilibrium conditions. And the net worth of the households is given by NH. So total wealth in the economy is Q times K, the total value of all the machines. Some of the wealth is held by the experts, and some of the wealth is actually held by the households. But it's not, of course, the households hold some of the machines, and they also extend some loans in form of debt or bond contracts to the experts. Importantly, the experts produce with capital, so there's no labor input in the setting, and they have a linear production function. So in particular, they're A times K. So AE is the productivity of the experts, and KE is the capital held, little KE is the capital held by the experts. We can write it as also as the total capital stock with capital K, and the fraction kappa is held by the experts times the productivity of the experts. Now we assume essentially that AE is a constant productivity for the experts. But for the household's production function, we assume how productive there is depends what fraction of the capital they're holding. So in a sense that, if they produce more, if the capital holdings is higher, if they have a larger fraction of total capital in the economy is in the household's hand, then actually they become less productive. Okay, so that's essentially, in a sense, what's going on. So they are the more machines, actually, if there's a fire sales or some sales, if these experts sell some machines to the households, the more machines the households are holding, the less productive they are. And that's reflected in this EH, the productivity of the households. That's a fraction of the capital the households are holding. That's actually declining in the aggregate capital share, okay, kappa H. So the productivity is always low of the households, but it's particularly low if they have to hold a large fraction of things. If they hold zero, then at the first marginal unit, they might be equally productive, but it's strictly decreasing. So the concavity is not really needed. The strictly decreasing is really the important component. Now, that's in terms of productivity, and then the financing constraints is that these experts, they would like to, it's a risky thing, potentially risky, not in this model, but they only issue debt. So they can only issue debt, and they can only issue debt up to a certain limit. So they can use the machines held, the value of the machines held by the experts can serve as a collateral, and they can only issue debt up to a fraction script L times that. So script L is smaller than or equal than 1. So that's how much debt they can issue. There's a leverage constraint. It's essentially, strictly speaking, a collateral constraint because it depends on how much leverage they can take. That's for the L. But it's not an exogenous leverage constraint. It depends on the value of the collateral. That's why it's a collateral constraint. Now, some further notation. If you think what's the net worth of all the experts, is just all the little n's. The little n is the net worth of an individual expert, and you just integrate them up, and then you get the aggregate net worth for all the experts. Similarly, for all the households, we do the same thing. So in this framework, heterogeneous agents means there are two types of agents, the experts and households. So there are only two types. And within the expert sector and within the household sector, they're all the same. Okay, so it keeps the aggregation simple. Of course, there's some heterogeneity, but it's only heterogeneity with respect to two different types of it. And we also assume that the total amount of physical capital is fixed. So how many machines there are in total in the economy is fixed. We relax this, and the homework will be to relax this later on, but this is not fixed necessarily. Now let's be a little bit more formal and dive into the math. So as I said before, the output of the expert is A times K. So AE for the expert's productivity times the number of machines for each individual expert. And that's, the total capital stock, which is fixed, times kappa. And for the households, it's AH, and which is a function of kappa H times the total of the machines held by the household sector, which is a fraction the whole times the total number of machines. This consumption rate of the experts might be also different. So that's how much, at what rate they consume. And this actually should be an H here. This is CH of T. Now, we assume for simplicity, and it turns out to be very tractable to assume that everybody has log utility. So they have different time preference rates, so that discount their preferences with rho E, the experts, while the households discount the time with rho H. And typically we assume, and we'll see later why we do that, that the experts are less patient or more impatient than the households. We also assume that the households are less productive than, as I mentioned before, than the experts. And if they hold no machines, then the first marginal unit, they're equally productive, but it's strictly decreasing in kappa H. So the more machines, what a larger fraction the households are holding, the less productive they become. They cannot issue any equity, but there's no uncertainty in this model. And the debt issuance is with a leverage constraint, and that's our leverage constraint or collateral constraint in better terms, because it's based on a collateral. And so how much you can borrow is endogenous on the price of the collateral. And so that's debt they can issue. If I divide it by the net worth of the experts, I can represent it by this way. And so then this is actually, so if I look at the right-hand side, that's this L, the leverage ratio I can do. And this is actually portfolio share of the experts on the physical capital. So that's denoted by theta K. So you can see that's the value of all the machines. Times kappa E is the value of the machines held by the experts, but divided by the net worth of the experts. That's, so the total value of all the machines divided by the experts, and this theta can be larger than 1 because these guys are highly levered. So if this were to be 1, then it's just holding all the net worth in machines. But if they hold, 3 times as many machines, and the value of machines is 3 times over than the net worth, this would be a number 3. So theta can be strictly large, and when the lever there is larger than 1. And so the debt has to be smaller than that. And all this can be rewritten. So the debt over net worth is just 1 minus theta k. So theta k is a portfolio share of the experts in their physical capital. Portfolio share is of course weighted by is in value terms, so it's weighted by the price. So we can translate this leverage constraint or this collateral constraint in these terms, in terms of portfolio shares. Now I mentioned that Kiyotaki-Moore says, okay, next period's price matters, not this period's price, but in continuous time setting, next period's price is just, QT plus DT, and this DT goes to 0. So this period's price and next period's price is the same as long as there are no jumps in the price level. And this Kiyotaki-Moore, there's essentially only one discontinuous MIT shock, so unanticipated MIT shock, which is not incorporated because it's unanticipated. And from then onwards, the price moves deterministically. So that the changes over the next tiny interval is essentially 0. So you just put in QT here. Now, let's do the portfolio choice and, of course, also the consumption choice if we want to do this. And the different ways to do this, and we will see this in the next lecture, the different ways how we can do the consumption choice. So we have the experts problem and we have the households problem. The experts problem is just maximize discounted future utility stream subject to the collateral constraint. That's just rephrasing this thing here. And then there's the evolution of the net worth. How does net worth evolve over time? So if I consume, then my net worth goes down over time. So that's the consumption rate. And of course, if I have some net worth, I get some risk-free interest rate from holding the risk-free debt. And then from holding physical capital, I get, this is my portfolio share on physical capital, I get the excess return on that. So I get the return on the physical capital minus the return on the risk-free rate. That's my excess return. Or you can rewrite it differently as well. You can say 1 minus theta, get the risk-free rate. So that's a fraction you put in the bond. And theta, you get the risky return. So 1 minus theta, if theta is larger than 1, then actually you pay the risk-free rate because you borrow, the expense of borrowing. Okay? But that's essentially the evolution of your net worth, the budget constraint. And for the households, it's the same. They don't want to borrow the household, so we don't have the collateral constraint to worry about. It's essentially the same arrangement. It's just with superscript LLHs rather than superscript E's. Now, this is a dynamic problem in continuous time, and there are different ways to solve that. But one way to set it up, and you've probably seen this if you have done some growth models, is to set up a Hamiltonian. We will go in details how to solve this in 3 different ways with the stochastic environment in the next lecture. But for now, we just assume the Hamiltonians and set up the Hamiltonians, take the first order conditions, and then we have the solutions for that. Now, how do you set up this Hamiltonian? So we have to search for the whole path, consumption path and portfolio path, in order to solve this maximum subject to these 2 constraints. So for the households, the Hamiltonian is just the utility flow in this period. So Hamiltonian at time t is a discounted utility flow plus, that's a Lagrange multiplier for the budget constraint. Then I have a Lagrange multiplier for the collateral constraint. Okay, so that's the way I write it. I write it in such a way that this Xi will be actually a stochastic discount factor later on. That's my budget constraint. We will see later on that this Xi will be my stochastic discount factor. And this one is actually my, I can use this as my Lagrange multiplier for the collateral constraint, but I multiply it by these elements, so it has a nicer interpretation later on. Okay, so this Xi NE L lambda L is my multiplier on Lagrange multiplier on the leverage constraint or the collateral constraint. Here I've just plugged in this network evolution that's just showing this, and then I've plugged in the collateral constraint here. For the households, I have the same problem as for the experts, except that I don't have a collateral constraint to worry about. So from this, you see already nice the so-called Fisher separation theorem, that the consumption choice and the portfolio choice, particularly for the households, is separate. So both of them do a portfolio choice, because the households also have to decide how many bonds to hold and how many machines, how much capital to hold. So they also choose a theta. But you can see that if I take the first order condition with respect to consumption, it shows up here and shows up here. And that's independent from portfolio choice if you take the first order condition with respect to theta, which shows up only here. Okay, so let's do the first order conditions. So first with respect to consumption, so let's go back. So consumption shows up here. So we have e to the power minus rho t u prime. And if we have log utility, u prime is just 1 over c. And then we have plus CE, this because the consumption shows up here. Consumption doesn't show up anywhere here. Similarly for the households. So we have this for the experts, the first order condition with respect to consumption for the experts, that's the first order condition with respect to consumption for the households. And you can see already, if I take log utility is 1 over c here, and this is also 1 over c, and this will be is my Lagrange multiplier on the budget constraint, and will turn out to be a stochastic discount factor. So it's a marginal utility of the value function with respect to an extra net worth. And because of log utility, the value function will also be of a log nature. And we will see in the next lecture, very clearly, we will derive this explicitly, that with log utility, the consumption is always rho times the net worth. So that's specific to the log utility, but it makes the analysis very simple. You take a certain net worth of the wealth of an agent times its time preference rate, and that's how much he wants to consume or she wants to consume. So that's essentially what the consumption rate looks like. It's just rho times the net worth. Somebody is twice as rich and has the same time preference rate, he consumes twice as much. But it's very proportional and makes the analysis very tractable. You can also see that if there's a change in net worth in percentage terms, as I said, 100% wealthier or twice as rich, he will consume twice as much. Now, what's the first order condition with respect to theta k? If I go back again, so theta k is not showing up anywhere here. It's only showing up here. And for the experts, it's also showing up there. And for the households, it's actually simple. It only shows up in this point. So I have essentially the first order condition of the household is just the excess return of the capital beyond the risk-free rate has to be 0. Okay. Now for the experts, it's more complex. Excess return is not 0 because it also shows up in this 1 minus L, the Lagrange multiplier in Lagrange multiplier of the collateral constraint. So let's have a look again. So that's the theta shows up here. The derivative, so it's Xi times N times the excess return, plus it shows up here, so 1 minus L, and I have put this Xi and this N as well in front of this one, so this cancels out, so I only have this lambda L to worry about. Okay. And that gives you then this first order condition here. It essentially says the expected or the return on the holding physical capital is higher than the risk-free rate if this Lagrange, if this collateral constraint is binding. I would like to borrow more, but can't. So if collateral constraint is not binding, the Lagrange multiplier will be 0, then there will be no excess return, and experts and households would have the same excess return. Now, what is this excess return? So you can think of it, if you hold some physical capital, what do you get? You get actually the output. So A times K, what you get, that's, you know, what this physical capital is producing. So, and divided by the value of the machine's Q times K. So K cancels out, that's the dividend yield, because essentially the capital is producing something. And there might also be a capital gain because the price of the capital might change over time. And in terms of percentage terms, that's the change, absolute change over time divided by Q gives you percentage term. So the return is given by dividend yield plus capital gains return, so percentage in capital gains. Now, if you look at the households, it's the same, but of course the dividend yield is different because they're not as productive. So how productive they are depends on the fraction they're holding. If they're holding a larger fraction, kappa H, they become less productive. So that's the dividend yield, and the capital gains rate is the same because there's only one asset price for the capital stock. So that if the asset price goes up, the same as capital gains rate happens there. But the dividend yield is different between the two guys. So what's the price dynamics for some proper initial conditions? So understanding the asset prices. So we have seen already the rate of return for the households is because, you know, the rate of return for the household's capital is equal to the risk-free rate. So this is just an equal sign. So you can see that the rate of return for capital is just the capital gains rate plus the dividend yield is equal to R. You can integrate this up and solve for the price, QT, and essentially get just, you know, what the price of a machine of the physical capital is just the future productivities of this machine, depending what the future kappas are, so the future productivities, discounted at the appropriate interest rate, at the risk-free rate, whatever the risk-free rate is. Of course, the risk-free rate can be time-varying over time. Okay, so that's essentially showing up here. You can, if you don't like the continuous time, you can look at the discrete time. So the capital gains rate is given by this in the continuous time, and that the dividend yield is in discrete time, and the dividend yield is given by this. So you have the QT is just the future, discounted future productivities, discounted at the appropriate discount rate, multi-period discount rate. So it goes, if this is S is 25, of course you have 25 short-term interest rates to focus upon. And the discount factor is the product of 25, 1 over 1 plus RT plus U's for this, and then all future productivities. So asset price is just the sum of the discounted dividend flows. That the asset price is always a backward equation because it takes the future and calculates it back from the future back to the present to get what's going on here. Now let's go back to the model and say what's the dynamics in the model. And typically when we solve this model, we always want to solve everything as a function of the state variable and, you know, what the state of the economy. And the state variable in these models often is the net worth share. What fraction of the total wealth, total net worth in the economy is held by the experts? And that's typically what we denote by eta. So this net worth of all the experts divided by net worth of everybody. So that's the net worth of the experts plus the net worth of the households. Now, what's the total net worth in the whole economy is just all the machines kappa bar times QT. That's the total net worth in the economy. And that's what our eta is, okay? And we have seen already the price dynamics given by this expression here. Now, how does eta evolve? And how is the net worth evolving? Of course, I can say, okay, if eta evolves, I have to calculate how the net worth of the experts is evolving relative to the total net worth. So that's essentially, I have to think, what's the drift? What's the change, the drift change, percentage change of the net worth? And that's just given by this expression. So there's the fraction eta is evolving how much the experts' net worth is evolving, and a fraction 1 minus L eta, that's the fraction which is with the households, the net worth, that's evolving how the household's net worth is evolving. Okay, so that's just what total net worth is evolving to. Now, what I really want to know is the net worth share. So what's net worth share? And that's essentially saying the drift of eta is the drift of NE minus the drift of N. Because when I look at drift, I look at percentage changes. So what's a ratio becomes a subtracting these two. So I subtract the drift of NE divided minus the drift of N. And that's essentially, if I put this in, so if I plug this in, what this thing is, and I can plug in here, then I get the drift of eta is just the difference in the two drifts, the net worth of the experts minus the drift of the net worth of the households, 1 times 1 minus eta. Okay? Because it comes, I subtract the total net worth, and if I plug this in, there's a 1 minus eta coming from this term here. Now, this drifts here, I can just, what is the drift of the net worth of the experts? The drift of the net worth of the experts minus the drift of the net worth of the households. So how do that differ? So if I go back to the previous one, so the drift of the net worth, so I see in this that differ in consumption and a different in returns. So the risk-free rate is the same. And in terms of consumption, they differ, but the consumption itself is just given rho times the net worth. So that difference in rho drives the difference in consumption. So I have essentially a difference in consumption rates depends on the difference in the patients. So that's the rho is the patients or the impatience of the experts minus rho is the impatience of the households. That's the difference in consumption rate that drives this. And then there's also a difference in how much money they make, what their return is on their physical capital. Okay, so they have essentially the return on the bond is the same, but they might have different portfolio shares, and essentially the return on holding physical capital is different because the experts are more productive than the households. And you can see once you add this all up and set everything in, the drift rate, how much eta moves, is just given the difference in consumption rates and the difference in the dividend yields. Okay, that's also the difference in returns because everything else is the same. So the price capital gains rate is the same, the risk rate is the same, and because once you replace the theta kh with the appropriate theta ke, so it has to add up to 1. This actually drops out, so you can actually, you get at the end, you get this drift rate. And that's actually very nice. You can see how does the drift and the wealth share move. So there's 1 minus eta from this term, depends only on the difference in the consumption rates, which depends on the difference in the patients, and theta k of the experts times the difference in the expected returns, which is the difference in the dividend yield. Okay. Now we can put everything together, and so we have now the drift. How does the system move? So the system depends on how the state variable moves, and given that we have only 2 types of agents, experts and households, there's only one wealth share. So it's a one-dimensional state variable. So we only have to keep track how does this one state variable moves over time, and given that it's deterministic, so we only have to keep track of the drift. How does the state variable eta moves? And we have seen this is actually how the state variable eta moves around. It's just the difference in the consumption rates or the time reference rate and the difference in the dividend yields. But of course, the model is more about just the drift of the state variable. We have a goods market clearing condition. So here we see the goods market clearing condition. How do we see that? So that's consumption demand. What's consumption demand? So let's first bring this QT kappa bar multiplied by eta t. So QT times kappa bar is the total wealth in the economy. If I multiply eta t, that's actually a fraction of the wealth, which is with the experts. And as I said, they consume rho times their net worth, rho times their wealth. So their wealth of the experts is rho is eta times QT kappa bar. That's the consumption of the experts. Now, what do the households consume? They consume, so they have a fraction of the total wealth is 1 minus eta. So eta is held by the experts, 1 minus eta is held by the households, times QT kappa K bar. That's the total wealth the households have. They consume at the rate rho h. So that's the total demand for the consumption good. What's the total supply we produce is just AE times kappa E, so a kappa fraction, so the total capital number of machines that's held by the experts, they produce at this rate AE, and a fraction kappa H is held by the households, and they are only the productivity is AH as a function of kappa H. So that's this in brackets is a function of kappa H. That's the productivity what the households produce in terms of output. So total output produced is this times kappa bar plus what the households produce times kappa bar. So that's a goods market clearing condition, total demand for the output good and total supply of the output good. Now we also have the capital market. So how the machines, so how do we find QT? And that has to be that a theta fraction, so the experts hold a fraction of their wealth. So what's their wealth? QT times, that's the total wealth in the economy, times eta is the total wealth of the experts. That's the total fraction theta they want to hold in physical capital. Yeah, that's the demand for machines by the households, by the experts. Similarly, that's the demand for the machines by the households. They have QT times K bar is total wealth in the economy. That's the total wealth by the households. That's their portfolio share. And that has to be equal to the total value of all machines. That's the capital market clearing condition. Now, of course, this theta, the portfolio share times eta, is the capital share of the experts. So the portfolio say, okay, I hold a certain fraction of my wealth in machines. If I multiply by eta, then I get the capital share as a number of machines, or the fraction of machines. So theta is in terms of shares of wealth in portfolio, while kappa is in the share of number of machines. Okay, and that's the kappa E is the fraction of shares held by the experts, and kappa H is the fraction of machines held by the households. Okay, and so I can express instead of thetas, I can also express it in terms of kappas, and then the capital market condition is KE plus KH has to be equal to 1. It's just add up to 100%. Okay. Now then I have a collateral constraint. The collateral constraint I can also rewrite using this, replacing the thetas and the etas with the kappas. So instead of having a theta, which we had before, I replace the theta with kappa when then a eta then shows up, but the collateral constraint becomes this way. So I have this equation. So here I can actually divide through this, and I see kappa E plus kappa H is equal to 1. That's my capital markets clearing condition. And this I can also divide by kappa bar here and get my goods market clearing condition. And if I put this together, and then I have, of course, also a bonds market clearing condition or debt market clearing condition, but I don't need it for by Walras law. Okay, so these are my equilibrium conditions. And that's how the system moves over time. That's the drift of eta. So if I simplify it, so if I just call kappa the kappa of the experts and kappa H, I call 1 minus kappa, then I can actually divide here by these elements. So I get these 3 equations, how the system is governed. Yeah, that's a goods market condition, a collateral constraint, and essentially kappa and kappa, kappa E is equal to 1 minus kappa. That's essentially my capital market condition. And then I can solve that, and I can solve this numerically, the whole system, in fully solve it without approximation. So solve it precisely. While the Kiyotaki-Moore discrete time is only solved log linearized, I can actually solve it precisely and say, okay, well, depending where the system is, how does the system look like? And so here is so what you see here, the state variable is our eta. So we only have the system the same. Where's the system? We just have to specify what's the well share of the experts. And of course, 1 minus eta is the well share of the households. And so you can see that as eta moves around, so if, for example, the households have only 20% of the wealth in the economy, their portfolio share is 2. So they put twice their wealth in machines. They cannot do more because they can't lever up more than that. So we have assumed here L is 5%, so they cannot lever up more than that. And if they become wealthier and wealthier, they'll actually become at some point, they don't even want to have such a high ratio of this. If you think once they are constrained here, is also when they're unconstrained, we have seen when unconstrained, the excess return, the Lagrange multiplier lambda is 0, so then the excess return is 0. So here we have it's just 0. But when they're constrained, there's an excess return popping up, and here's the size of the excess return. The lower the wealth share is of the experts, the more binding is this collateral constraint. The experts really would like to lever up more, but they can't because of their leverage constraint. And then it's actually the case that that becomes more and more binding. And you can also see that, that actually Q is dropping down. So when the experts have low wealth share, so net worth share is much lower, then the households, the experts would like to hold more physical capital, they are the more productive ones, but they can't really hold so much. So a lot of the machines are actually held by the households. The households are less productive, and the more they hold, the less productive they become. And then the price is depressed. The Q is very low. There's actually a decline in the price for high eta values, and that comes from the different rows. Remember that here we assume that the experts, they're less patient than the households. And so that's essentially how the system, and here's how the system evolves. So you can see the drift in eta. If eta is above 0.4, then the drift in eta is negative, so the system drifts towards this point. And if the wealth share is below 0.4, then actually it is the case that the system moves positively to this point. And 0.4 is the stochastic steady state. So that, or it's the steady state. There's no stochastic element. It's the steady state where the drift is 0 and it doesn't move. So it will stay at 0.4. And then that's essentially at this steady state. It will be constrained, and at 0.4 we have a certain Q, and this will be the steady state. And it could be that as an unanticipated negative shock, then the system might be thrown to 0.2, and then it travels back, first very fast, and then slower and slower back to 0.4. So it drops from 0.4, the price drops down, and then the price goes back up to goes up until eta 0.4 is hit. And it's also here the excess return will be high, and then it goes back down here. But this we assumed here the setting in such a way that at the steady state, the collateral constraint is binding. Now you can also study an impulse response function. That's essentially what I did already in a sense, where I say, okay, we have an eta shock, so eta goes down by 30%, but there will be amplification. We will show this subsequently in more detail, but there's a decline by 30% because of amplification. It goes down more than 50%, and then over time, the system travels back. So the wealth share relative to steady state, we started the steady state 0.4, then the system is going back. So deviation from the steady state is then going deterministically back to 0. And there's also a deviation in price. So there's a steady state price, Q star, the QT drops down, and then it goes back. Now, how do we solve that around the steady state? So typically the way Kiyotaki-Moore solves it, and typically how first generation models solve the setting, is not to solve it globally, what we did here, but to say, okay, let's first solve the steady state and derive its properties. That was this 0.4 in the setting. where the drift is 0, and then we log linearize around it and see how then the system moves around. So essentially what one can do is say, let's solve this point. Okay, let's get this number, and let's also get what the Q is and what the theta is, and let's make sure in the steady state this constraint is binding, and then we log linearize around it such that if there's log in this x-axis of eta, this would be, you know, linearly approximated. Okay. So let's first stay in the steady state. So let's first find out whether in the steady state the collateral constraint is binding or not. And we could argue that the collateral constraint is always binding in steady state. If the collateral constraint is not binding in steady state, then we have seen the Lagrange multiplier would be 0, and hence the return for the experts on capital is equal to the return of the experts on the households, and it also would mean that they have the same returns, and so it has to be the case that the dividend yield is also the same. Okay. So note that the constraint does not bind only if kappa is equals to 1. So if kappa is equals to 1, so if 100% of the machines are held by the experts, then we said for the first marginal unit of the households, if they buy the first machine, they're as productive. By the second machine, they're already less productive and so forth. Then it would work. Now, if that's the case, if the whole 100%, so the drift is given by this expression. So if this is the case that the dividend yield is the same, so then the second term of our equation, so going back to this equation, if this is the same, E and AH is the same, this is just a function of 1 minus kappa, AH. If this is the same, this whole term drops out, so we just have the drift will be just given by the difference in time reference rates. And then it would be, you know, given that we assume that the patient's rho E is higher than rho H, then it's the case that drift would be negative, so eta declines. So it can't be, so eta would actually decline over time, okay? So that's not feasible in a sense, because eta would decline all the time, and then it would not be at this stage where they always hold 100% of the physical capital stock. Now, let's characterize the steady state. So let's assume a setting where we can solve this explicitly. So steady state, again, the drift in eta is actually equal to 0. So we have this equation here. So that's now, let's not assume that there's no difference in dividend yield. And this was the Goods-Mark occurring condition. So remember, this was the network share. So we have the Goods-Mark occurring condition, and we have this this mu eta equation, but we set mu eta equal to 0. We get the difference in the time preference rate and the difference in the dividend yield, which drives this. And at the steady state, the mu eta is equal to 0. And that's why we put in this kappa star. So first of all, we have seen from the previous argument that the collateral constraint is binding. So we can replace, we put in the capital constraint. So kappa star is equal to eta star divided by 1 minus L. We put it in, and then we get this expression, these two expressions. So if we combine these two, we get these expressions, the Goods-Mark condition on the evolution of eta, assuming in the steady state eta is not drifting, because in steady state eta stays the same. If we combine it to, it's just simple algebra, we get this expression for the steady state price of a machine. It's the productivity of the households, 1 minus kappa. So that's just EH as a function of 1 minus kappa star. That's the steady state capital share divided by the time preference rates of the households. The households essentially price their price, the machines, because they're the marginal buyers. So if you sell it to them, so that's, and given the holding, the steady state holding of the households, that's their productivity. And you can see here, it's essentially a Gordon growth formula. If they were to hold it forever in steady state, they hold this fraction forever, it's just divided by rho H. Okay. And where this kappa star is implicitly given by this expression here. Okay. So that gives us the kappa star, so that's coming from these equations as well. And so what we do then, so that's, we assume for this AH as a function of 1 minus kappa, I just assume that that's AE times kappa. Okay, that's an assumption to keep the analysis even simpler. So far I have not assumed the functional form for the productivity of the households, which of course depends on the fraction of the capital they're holding. So it's 1 minus K, that's that's a fraction of the experts holding. And I just assume it's AE times kappa. Okay, if the experts hold 100%, then this is just they're as productive as the experts. But if the experts now hold a larger fraction, the productivity is, hold on a minute. So if the experts hold a larger fraction, that means the households hold a smaller fraction, then actually they are more productive, the households. Okay. So once I plug in this particular form, we can actually solve for kappa star and eta star in closed form. Of these guys just related by 1 minus L. There's just a 1 minus L multiplication here. So the kappa star is given with this expression, primarily driven by the difference in time preference rates. And the eta star is given with this expression explicitly. That's just some simple algebra. So this characterizes the steady state in all its form. That's for, at eta star, when the eta is not drifting anywhere. So that's the case when we are in this point where the drift of eta is equal to 0. So certain features we can derive from that. So for this particular example, I've specified here where this productivity of the households is given by a productivity of experts times the fraction held by the experts. If they hold more, then that means the households hold less, and hence they're marginally more productive. So for higher leverage ratio, it is the case that the kappa star is the steady state capital share is higher. So of course, then the experts hold a larger fraction of the capital. If they can lever more, they want to lever more, they like it, and they will hold. It's also the case that they actually, because they are competing by levering up, they actually wealth share in steady state of the experts will be lower. Okay, so that's a difference. So if we shift that, so that's essentially for higher leverage, you can see how these things play out. So if I increase L, the leverage ratio, so you can see if I increase the L here, it's a minus in denominator, so kappa goes up, but here, let me divide by 1 minus L in both situations. Divide here by 1 over 1 minus L. You can see it goes in the other direction. For higher leverage also means higher price of capital is higher, and total wealth in the economy is also higher. Okay, so we can derive from some very nice properties. The net worth, the total net worth, so we see already the net worth share is lower, but the net worth is higher. So one is the net worth share. So of course, the net worth share can be lower if it can still be the case that the net worth is higher because total wealth in the economy is higher. And so we can do this comparative static exercises. But what does the comparative static exercise mean? Is that, okay, let's change the leverage ratio and have one economy with a certain leverage ratio and now do another economy with a higher leverage ratio, and to just compare the two economies. It's not the dynamics. If we change the leverage ratio, how does the dynamics play out? It's just comparing across two different economies, comparing two steady state. What we really want to do is to say, okay, there's a shock to the system, for example, to L. How does then the dynamics, how does the prices move, and then how does to converge back to a new steady state potentially? The system shock I will do is not really an L shock, but a different shock. But that's a key distinction I would like to draw. Comparative static across steady states is something different than saying, okay, I'm in a steady state and I shock the system, and then I want to see the whole dynamics, how the dynamics play out, potentially ending up in a new steady state in the long run. Now, the way Kiyotaki Moore do this and the way most macro economies economists do work on this, they're log linearized around the steady state. So first you calculate the steady state, you can characterize the steady state, and then you log linearize around it. And then you make a little perturbation, and then you see how the system behaves. So the analytical solutions, might be hard to obtain analytically, but you can do a localization around the steady state. And the one way to do that is to say, okay, I'd say if I deviate my eta from the steady state, so you can also say log of eta minus log of eta star, or take the ratio, that's the same thing. And that's why I do a log linearization. What is that? And I call this eta hat. Okay? And I do the same thing, log of q minus log of q star, I call this q hat. And for the risk-free rate and also for the household's productivity, I call it this. So I can derive the expressions for these as a function of eta. So I just take the log of it and do a Taylor approximation, a first order Taylor approximation around that. And then I can see how does essentially the state dynamics and the price dynamics move around over time. And then I get this expression. So the change in eta, so the log linearized change, how this deviation from the steady state in a log sense moves around depends on the productivity of the households and how the Q moves around. And how Q itself moves around depends how R moves around and Q moves around minus the productivity moves around. Of course, I have not fully solved it because these guys also have to have equations and plug it in. So I can plug it in, but it becomes ugly. So I don't do it explicitly. I just show you how to do that. But the key insight is that you solve for the steady state, you do a Taylor you take log, you do a Taylor approximation from this log around the steady state, and then you say you shock the system, and then you can characterize how the system moves back deterministically to the steady state. And of course, what I'm mostly interested in is how eta moves around, because if I know, as soon as I know eta moving around, all other variables are functions of eta. That's my state variable. All other variables are function of the state variable. Here's a one-dimensional state variable, a function of eta. Of course, if I have only two types of agents, if I have three types of agents, this would be not a scalar, it would be a two-dimensional eta variable, because I have two well shares. If I have four types of agents, I have three state variable would be three-dimensional. And if I have a continuum of agents, different types of agents with different continuum of types, then I would have, this would be a whole continuum, a whole distribution as my state variable. That makes the analysis, of course, much more challenging. Now, but if I want to log linearization, so what I've depicted here, you've seen already this blue thing, but now I depict it as a function of the log of eta because I log linearize. And you can see that's the precise solutions we had before from analytical precise solution, numerically derived. And when you log linearize around the steady state, you just assume this linear function. You see, it works pretty well for small shocks. Of course, if the shocks go larger, and if you go to the unconstrained region, it's very misleading. And if it goes very large on this direction, it's also misleading because the true relationship is given by this blue relationship. That's a drift. So if we go high, so this was around 0.4 of eta. So in log of eta is minus 0.8 or something. And so if we go high, it drifts back here. And you would assume here, of course, it drifts way faster back in this region than it actually does. And you also assume here actually it drifts faster back in the true blue one compared to what the log linear approximation does. But it's around the steady state, it's pretty precise. Of course, if there was a steady state where the kink is, it would be very imprecise. So one has to make sure that the steady state is in the constraint of a region where the collateral constraint is binding. Now, what I want to do next is that I would like to decompose these amplification effects and just highlight how the decomposition works. So if I want to decompose it, I start at a steady state, a Q star, eta star, and kappa star. Remember, everything is a function of eta star. And I shock the system. I want to say, how does it recover how does it go back to the steady state? I assumed in this first generation models, of course, you always deterministically recover and go towards the steady state in the setting. So the shock I want to analyze is like I redistribute a fraction of the experts' net worth towards the households. So the households might be the steady state. They have 40% of the wealth share is net worth share is with the experts. And I take, let's say, some fraction away and give it to the households. Now, eta is much lower. That's, it's a similar in Kiyotaki-Moore original paper. Their shock is essentially productivity of the experts for one period. And then itself makes them poorer for one period. And then after this one period, they go back to the old productivity level. Here, one period is like in continuous time is one instant. So one instant productivity shock will not do much. So I have to do something which is more equivalent what their productivity shock does. And so we do a redistribution from the experts' net worth share to the households' net worth share. And let's suppose 30% of the net worth share is redistributed. And then I want to understand the impulse response function with this deterministic recovery. So there's, of course, an immediate impact. So if I take some net worth away, let's say 30% of the net worth share, I take it away and redistribute it, and that itself will lower eta immediately. But because this lower eta is then associated with a lower Q, there's a price net worth effect. So the decline, so there's this directed redistributive effect from the initial shock. That's what, let's say, the shock does. And then there's on top of it, there's an endogenous response because now I have a lower Q eta after the shock. That corresponds to a lower Q. And because these experts were actually levered, they may suffer further losses. That leads to even further eta decline. Okay, so there's this net worth price net worth effect, which has to be taken into account. So even though the initial shock was only 30%, the price net worth effect will actually make it larger. But then on top of that, there's a third effect. The third effect is that if the QT goes down, the collateral constraint is essentially tightening. That means they have to scale back the operation, these experts, and that actually makes it go down even further. And that makes the Q go down too. So this tightening of the collateral constraint feeds back to the price net worth effect. And this, of course, leads to lower Q. That leads to a tightening of collateral constraint further, and there's a feedback effect. So there's some feedback effects only within this price net worth effect. And then there's a more feedback effects from the price collateral constraint. So that happens at time t equals 0. And then, of course, going forward, then the system recovers and feeds back. Of course, how the system recovers is also feeding back how big the impact is at time equals 0. We have seen this before. If the system comes back very quickly, the initial price effects will be smaller. So the price net worth effect will be smaller, but the price collateral effect will be smaller too. So the subsequent dynamics is always implications for these effects at time equals 0. That's this dynamic amplification going on. So what I want to do essentially is to switch off this price collateral effect. So let's assume the collateral constraint is not tightening as the equilibrium price goes down, because the households who lend to the experts, they might not tighten the collateral requirements. The Q goes down, but they go, we still pretend the equilibrium price for collateral purposes only, we price the collateral as is we in the steady state price. And so there's not tightening. And then we can isolate it, what is due to the direct effect and the price net worth effect, and what's on top of it, what's due to the price collateral effect. Okay, that's essentially the exercise. So here's just to show a preview of what's going on. So we have this figure, we had the blue one, and we had before. If you have all three effects at work, here we have an impulse response function. If 30% of eta negative redistribution, so we have essentially a 30% decline, and then we have seen it actually translates to a 52 or 53% decline because of this amplification. And that's what you can see already. If we had a Q star constraint, so if the collateral constraint would be based, the collateral would be valued, and that's often what central banks do. They evaluate at the Q star at a steady state, the decline would actually be less so. Okay, so that's for eta. The same we can see also for the deviation in price. You see, if you have a Q star constraint, the price decline would be only 10%. Otherwise, it would be almost 30%. Okay. Now, what's important to notice here is that there's a huge, much bigger price decline, and the price is always lower for in the blue one, where the collateral constraint is on the actual equilibrium price rather than the steady state price. If you look at the state variable, how the state variable evolves, it actually does not need to be the case that the blue line is always below the red line. Okay, we can see actually the blue line is actually at some point after a certain number of periods is actually above the red line. And that's because the system recovers, it's hit faster, but the system is recovering faster if the price can adjust fully rather than if the collateral constraint becomes more binding. So in both settings, we have an equilibrium price. So we only change the price feeding into the collateral constraint. In both settings, the price itself is endogenous and an equilibrium price. Now let's first understand this decomposition in these three effects there. So essentially at time t, we are in the steady state circumstances, and then we shock the system. We do a redistribution. So we start with the steady state eta, and then we take, let's say, 30% away, and then we have a eta prime. And this eta prime leads to a new price and new capital holdings, and it solves this. So there's a goods market clearing condition. So remember, this was the numerator, essentially, this goods supply, and the denominator times Q prime is the goods demand. So this was a goods market clearing condition where we get the equilibrium price of the capital. Then we have this constraint. If we have the constraint, that's where we plugged in already this eta prime and this kappa prime. That was our constraint, but now this eta prime is eta star 1 minus epsilon. And if we, instead of using the equilibrium price, we use the steady state Q primes, we have to have a correcting factor showing up here. Okay, so if we were to put in Q star, Q prime here, then this would go away. That's where I get this equation here. But essentially what's going on is that we have to solve this iteratively. So to consider the first round effect, the second round effects, and so forth. So what's going on, there's an eta, we shift some eta from the experts to the households. And that destroys some of their net worth share, but that leads to a change in Q. And because the experts are levered, there will be a second round effect on eta and also on kappa. And that leads to a further price decline. And that leads to another eta effect. So there's multiple rounds, and that's essentially the new balance sheet is then given for the first round effects given by this expression, second round effects, third round effects until the system converges. So we solve this iteratively. So just to make sure, to say it again, as we redistribute some of the wealth, the eta drops. The lower eta now corresponds to a lower Q, and the lower Q means there's additional wealth losses, net worth losses for the experts because they were holding much more physical capital. They were levered, and so this drops the eta further. And this further drop in eta lowers the Q again, and this lowering Q again leads to a lower eta again, and so forth until the system converges. So we have to figure this out, and we have to do this under the constraint where we just, the collateral constraint always assumes the equilibrium price determining the collateral constraint, or we just assume the collateral constraint always takes the steady state price. So the collateral constraint itself is not tightening because of a further price decline. Okay, and that's this where we have this Q star constraint floating in. So, and here you can see the picture when we decompose, and we had this blue figure before, the difference between the Q constraint and the Q star constraint. So blue is the Q constraint, and red is the Q star constraint. So what you can see is that Now let's suppose we start at 0.4 and we go down 30% of 0.4, we go down here. The constraint is fully binding. We cannot increase the portfolio share, while if you have Q star constraint, the constraint is less binding, okay? And that also means, because the constraint is less binding, the excess return is lower in the red line than in the blue line. So if the constraint is less binding, they can take on more. The Lagrange multiplier is less constraining, so the red constraint is a less constraining, so you get a less high excess return from this. And that's also why the system recovers faster in the system. You can see the drift of eta is higher in the blue one when the constraint becomes more binding, because the experts get the higher excess return, so the system recovers faster. And that explains also why at some point the system recovers faster, and over time, actually it overshoots the less constraining Q star constraint. And that's because of this additional excess return you get, and this translates into higher drift in eta in the blue line, slightly higher drift in eta than in the red line with the less constraining Q star constraint. Of course, you can see as Q goes down, as eta goes down, Q goes down. In the less constraining one, the price goes down by less compared to the blue one when the constraint becomes more binding. So you can see the additional amplification effects coming from this. The eta goes down and you get more price decline from this. And that's, of course, corresponds to this, that you have a much sharper price decline if the constraint becomes more constraining as Q goes down relative to the Q star constraint, where the constraint is always having the steady state price. Okay, so that's essentially what one can do. So this is solve the system again globally, analytically. Of course, you can do this also with a log linearized system as well. You could do the holding log linearized around the steady state, take logs and do first order Taylor approximations. So we have the price dynamics given by this expression, and we have the eta dynamics given by this expression under the Q constraint, collateral constraint, and under Q star collateral constraint, where there's the only difference here, if you look at the two equations, is this additional term showing up. Of course, once you linearize around the steady state, you assume you stay close around the steady state. It's not dramatic away from the steady state. So if you go back to the precise solution, if I were to, there's quite some gap here. So you linearize around here, log linearize, and you would approximate it with this linear settings. And of course, you might get, for small changes, it makes not a big difference, but for large changes in eta, it makes a significant difference. Now, that's essentially what I wanted to do. So let me just recap. So in Kiyotaki-Moore, it is the case, we have two types of agents. We have heterogeneous agents. We have experts and households. We have hence one well share. That's a scalar. That's a single variable. That's our state variable that moves around. So we have to understand how this state variable moves around. All other variables are functions of this eta, this scalar, this well share variable. And that keeps the whole analysis tractable. So it's just a single scalar variable to worry about. And then we analyzed the setting, saying what is the impact of a shock? And let's, for example, the experts suddenly become much less wealthy compared to the households. We shift some wealth towards the households. How does this amplify? And this amplifies not only because we have the initial shock, but we also have this price decline. The price decline leads to even further decline because the experts are levered to a further decline in net worth of the experts. So that's the price net worth effect. But because the price decline also tightens the collateral constraint, it makes the whole situation even worse. Okay, and this is not only temporarily, it amplifies dynamically, and that's what's going on in this Kiyotaki-Moore model. And isolating what's the price net worth effect and what's the price collateral effect, this gives you this additional hit. Whether this is, so initially when the shock occurs, of course, the collateral constraint makes the situation much, much worse, but it also leads to a faster recovery subsequently because excess return for the experts to recover again afterwards is also faster. That's essentially what the analysis shows. Now, so far, we had these two groups, but we have assumed the total number of machines, the total capital stock, K bar, is fixed. Okay. So we didn't allow that there will be additional investment for new machines. So what you can do, and you can generalize the analysis by allowing, that you can convert certain consumption goods into physical capital goods. Okay, so you take the apples, that's our consumption good, and put it into machines or trees and let new trees grow. And typically what we do is the capital conversion function is phi of iota, and iota is the investment rate. So the change in the number of machines or trees is just iota is your investment rate as a concave function out of it. And that's, iota times K is the real investment you put in. So the investment rate times K, that's the real investment you put in. How many apples you plant to get new trees. And the first apples you plant, you get a lot of trees, but then it's concave, it becomes less effective. Essentially, as you plant with higher investment rate, it becomes less effective to get new trees out of it. There's a concave function. You can also make it linear. That's a special case, but typically we assume some adjustment cost that if you want to immediately make out of consumption a lot of physical capital goods, it becomes less effective. Of course, the capital stock is also changing by depreciation rate. So if there's a depreciation rate of delta, certain number of trees grow old and fall over and deviate, or machines break down. There's a depreciation rate of capital. Now, what I want you to do is to study this in the problem set. If you enlarge and generalize the Kiyotaki-Moore model, the first part of the Kiyotaki-Moore model, also in continuous time, and analyze if, now there's an investment decision on top of it. Now, you don't only have a consumption choice, with log utility is just rho times the net worth as your consumption stays the same. You also have a portfolio choice, like the Merton problem. The portfolio choice stays the same, but now you also have an investment choice. But the investment choice is just a period by period within a period choice. So there's no time to build. Models where you invest now and you get many periods later, you get some new physical capital. Here, you convert it right away, the consumption into capital goods within the same period. So it's essentially a static problem. So it's a very simple problem to enlarge this setting. And what you can see, you get this Tobin's Q. So the optimal investment rate depends on the price of the physical capital. If the physical capital is very expensive, of course it makes sense. Then you convert more of the consumption goods in new physical capital. The apple is worth 1 because it's our numeraire. The consumption good is worth 1 as a price of 1. If the price of the machine is higher, you convert more apples into machines or physical capital. And the way you do it is just given this expression. So the higher of the price of the machines, the higher the investment rate. Remember, phi is a concave function. So I should have stated that. Phi, the first derivative is positive, and the second derivative is negative. So the higher this. So often what we assume is we assume a phi function of this form, of this log form. So the literature typically assumes a quadratic, but this log specification we found earlier is more tractable. So where little phi is essentially the adjustment cost. If little phi is 0, this becomes a linear function. And the higher phi is the more curved, more concave this function is. And you can see once you take the derivative of this, you can see it gives you a very nice Q formula and relinks the price of the physical capital to an investment rate in a nice linear way. So the homework for you is to redo all the equations we did above in Kiyotaki-Moore continuous time version with this possible investment rate creating out of consumption goods new physical capital. Just to give you some hint, of course, what will change, we will have an additional first order condition. That's the one I've just derived. But we also have something in the goods market condition, because how much we can consume, there's also some investment going away. So there will be some additional investment, or the total supply for apples to consume is now minus some iota because it's done taken away for investment purposes. You can't consume it anymore. So the goods market condition will change as well. But that's for you to figure out in the homework. Okay, so before I conclude, I would like to relate now this to The second very important earlier work on microfinance models, which is also discrete time, it's Bernanke, Görtler, Gilchrist, 1999. It's also a fully fledged DSG model. So it's a dynamic stochastic channel equilibrium model. So it's fully fledged now because it also has some price stickiness. So Kiyotaki has no price stickiness in it. It's just focused on this dynamic amplification. The Bernanke, Görtler, Gilchrist is a fully fledged, everything is in it with price stickiness and idiosyncratic firm risk and so things which we don't have in Kiyotaki. So like in Kiyotaki, there is an aggregate shock and it's unanticipated zero probability shock where productivity is shocked. And then there's no fire cells to less productive households. So unlike in Kiyotaki, so they don't have these two sectors where there's the expert sector and the household sector, and there's fire cells of physical capital from the expert sector to the household sector. You don't have that. Rather than in BGG, it is the case that actually the firms, they have to convert some of this physical capital back to consumption goods at a cost. Okay, so what we did so far, but just explained the slide before, is that you convert some consumption goods into physical capital. That's costly the faster you do it, but you can potentially also go the other way around. You disinvest, you convert the tree back into apples, is literally speaking, but it has some cost. But sometimes you have some consumption goods which you can use for both consumption or physical capital, and you can convert it back, but it is all costly in this. So rather than having fire cells to less productive agents, and that's where the distortion comes from, here is essentially you scale back your capital and convert it back to consumption goods. That causes some cost because of this phi adjustment cost function we had before. Now, the financial frictions are also slightly different in BGG compared to Kiyotaki-Moore. There's no equity issuance. That's the same as in Kiyotaki-Moore. Remember, in Kiyotaki-Moore, there's no risk. There's only some zero probability shock, which you don't anticipate, so there is no equity. Nobody wants to issue some equity. And there's a collateral constraint, how much debt you can issue. Now, in BGG, you cannot issue equity, and you can issue debt based on a costly state verification. So it has a nice micro foundation, a la Townsend, the costly state verification, where you can issue debt, and that's the only thing you want to issue. So if a firm defaults, so firms can default, and this debt is state contingent, so it's defaultable, so it has some state contingent element to it. So after an idiosyncratic negative shock, so each firm has its own idiosyncratic shocks in BGG. So unlike in Kiyotaki-Moore, where all experts are the same, now some firms default and others don't default because some have bigger negative idiosyncratic shocks than others. And if you default, the borrower or the lender has to verify. So you say the way the costly state verification works is that, oh, I default, I cannot pay back my debt. Then the lender has to go there and has to verify, oh, was this really true that your cash flow, your productivity turn out so low? And there's a cost of doing that. But the lender anticipates that a certain fraction of the borrowers will default, and he has to pay this verification cost, and he will charge for this verification cost in form of a higher interest rate upfront. Now, what's important is that to minimize this verification costs, a debt contract is the optimal thing, because as long as the borrower pays back its land, it pays back the same amount, so you don't have to verify at all. If he pays back, you don't have to verify. You save on verification costs. If you don't pay back, then you have to verify. Now, if now there's an aggregate shock, a zero probability aggregate shock, suddenly all the firms are less well capitalized, then the idiosyncratic shocks will be essentially will lead to more defaults and hence to more verification costs, because now suddenly you have to pay more for the verification costs. Or the verifications are more likely because there are more defaults, so you have to verify more, the more verification costs. And that means the lenders will charge ex ante, knowing now that there was a negative shock and there will be more defaults, they will charge a higher interest rate because they anticipate a higher verification cost, so the funding costs increase. So even though the verification costs have to be paid by the lender will charge a high interest rate. So de facto, the borrowing firm pays the verification costs and expectations. So let me state this again. It's the first generation model as well. You have this MIT shock, unanticipated probability shock of an aggregate shock, that essentially makes the idiosyncratic risk leading to more defaults among the firms. And when the aggregate shock occurred, we don't know which firm defaults yet. That's only realized once the idiosyncratic shock realizes. The debt contract is the optimal contract, the defaultable debt contract, so it's stake contingent in this framework, because it minimizes the verification costs. Because whenever the debt is paid back, nobody has to verify anything, and we save on the verification costs. But if there's negative aggregate shock, more firms will default after the idiosyncratic shocks, and hence more verification costs have to be paid. That leads in anticipation because the lenders know this will happen, they charge a higher interest rate. So the funding costs for the firms go up because in expectations, they have to pay the verification costs, which arise subsequently. And putting all of this together in a nice macro model, including stickiness in all elements and calibrating this model, that's what the Bernanke-Görtler-Gilchrist does in this setting. It's a fully fledged DSG model. The main differences are, saying it again, financial frictions is not a collateral constraint, but a cost-state verification. And its other main friction is that there's no fire sale to another sector going on, to the household sector. It's essentially you have to scale back the operation. And that's essentially what's going on by Bernanke-Görtler-Gilchrist. Now, in all of these first generation models, there's a critique. The critique is that, you always have this unanticipated zero probability shock. And then after the shock has occurred, we know there's no second shock occurring anymore. There's only a single shock occurring. After shock, we deterministically walk back toward the steady state. So the length of the slump is deterministic. You don't need an additional safety cushion. While in the real world, it's like you have a negative shock, and then you say, oh my God, there might be another shock, and there might be even more likely, and I have to build up a bigger safety cushion. I have to do more precautionary savings, and that depresses consumption even further. All of these elements are not incorporated in this type of models. And this essentially is very important if you want to understand more generally what's going on. You have to understand the whole volatility dynamics. It might also be the case that after the first shock, the volatility will be even higher. Here is the case, there's no volatility you anticipate, and there's totally out of the blue comes a shock, and then subsequently you anticipate no volatility going forward. What we want to do in this course, essentially, we want to have a rich volatility dynamics and going beyond simple impulse response functions where we assume after shock there's no volatility dynamics anymore. So what are the main takeaways and the conclusions from the first lecture? So what we did is we did first define what is macrofinance. It's risk focused, it's risk premia, price of risk times risk exogenous plus endogenous risk focused. We contrasted different financial frictions. The one is incubate markets. That's one thing. You cannot issue contingent claims the way you want to issue them or not to a sufficient amount. And there's some debt issuance constraints. Can be explicit debt leverage constraints or collateral, where the price also enters the how much you can issue. And then we studied a first generation macrofinance model, in particular the continuous time version, a continuous time, newly developed continuous time version of Kiyotaki-Moore. There was a zero probability aggregate shock, but typically they log linearize around the steady state. You derive the steady state, and then you log linearize around the steady state. And then agents deterministically believe we go back to the steady state. So without anticipated risk, collateral constraint binds an equilibrium, and it makes essentially collateral constraint. As the price goes down, the collateral constraint becomes even more binding, and that depresses the price even further. And it's around essentially the way to generate this. You have to assume that the collateral constraint binds in equilibrium in the steady state. So if you're in a steady state where the collateral constraint were not to bind, then the shock would not do something because it's all a small shock log linearized around the steady state. So you have to move the steady state in a binding in a range such that the collateral constraint binds in steady state, and then you can shock the system and can do the analysis. There's no distinction between small shocks and large shocks, which are very important. So log linearization is an okay approximation if you move the steady state in the collateral constraint, and it's a good approximation if the shocks are not too large. Now, next time, we will do some stochastic modeling. Remember, there was so far no Brownian motion or anything floating around. It's all one zero probability shock, and everything is deterministically only is driven by drift rates. There were no volatility terms floating around. For second generation models, where volatility moves endogenously, so endogenous risk is time varying, and the price of risk is also time varying, we need essentially stochastic type of modeling, stochastic calculus, and that's what we do next. But once we do that, we can actually derive this endogenous risk in the volatility dynamics itself. So we get some very rich picture like this. So where, as function of the state variable eta, it is the case that the drift is a blue line. You know, if you're below the steady state, you might drift back fast. If you're above the steady state, you might drift towards the steady state as well. But the volatility is there's some fundamental volatility, but there's some endogenous volatility. So there's a lot of high volatility in this crisis region where the system moves around a lot. And that might lead to more precautionary savings. So everybody wants to flight into safety and save more in the safe asset. That distorts the portfolio choice even further. And that leaves you a role for safe assets, a role for money, highly nonlinear. You can see already that things are highly nonlinear in this picture. And it gives you also to this endogenous fat tails and skewness of distributions, and also to the volatility paradox. You know, times when the measured volatility is very low exogenously, it might be build up some hidden exogenous volatility. So even if the volatility is very low, it seems like the actual total volatility is low. So if you look at this picture, by very low eta values, the fundamental volatility might be low, but actually actual volatility is much, much higher. And to talk about the Minsky financial instability hypothesis and more general processes, it's actually very important to take risk and price of risk and endogenous risk and potentially also multiple equilibria seriously and study the nonlinearities where we cannot really do a log linear approximation around the steady state alone. So that should give you a little bit of a taste for what's coming up. The next lecture will be a warm-up where we just explain things, why it is important, why it's helpful to have some continuous time modeling techniques, and how to do portfolio choice, and what the optimal maximization procedures, the three different ways of doing it, and what are the good ways of doing that. So thanks a lot for listening. I hope you got a flavor what this course is about, and first linking it to traditional first generation microfinance models, and then we go on from there subsequently from next week onwards. Thanks again. Talk to you soon. Cheers.